So let's talk about bonds. After a really brutal crash, pretty much the worst in a century, everyone's asking the same thing. Are they back? And, the big question is, should you be buying them right now? We're going to break it all down. Okay, to really get where we are today, you have to see where we just came from. And it was ugly. In 2022, the main benchmark for the bond market just plummeted. We're talking a devastating 13% loss. Now, that might not sound like a huge number compared to stocks, but for bonds, that's not just a bad year. It was a complete historic collapse. Seriously, that 1 year was the worst showing for bonds since the index was even created, almost 50 years ago. And it just shattered this idea we've all had for decades, that bonds are the safe part of your portfolio, the thing that's supposed to hold steady when the stock market goes crazy. So what on earth happened? All right, let's solve this mystery. It really comes down to one single force, the one that basically controls the entire bond market. And boy, did it take some dramatic action. And that force was the Federal Reserve. They were in this desperate fight against crazy high inflation, and they just started hiking interest rates at a speed we haven't seen in forever. Now, that move has a really direct, almost mechanical, and painful effect on bonds that already exist. To see why, we gotta do a quick primer on how this stuff actually works. Okay, so why did those rate hikes cause such a disaster? Let's quickly pull back the curtain on what a bond is. I promise, it's way simpler than it sounds. Think of it this way. A bond is basically just an IOU. It's you lending money to a government or a big company. In return, they promise to pay you regular interest payments. That's called the coupon. And then, at the end of the term, they give you your original money back. Simple, right? But the price of that IOU, what people are willing to pay for it on any given day, that's where things get interesting. This right here is the absolute golden rule of bonds. Just picture a seesaw. On one end, you have interest rates. On the other, you have existing bond prices. When interest rates go up, your old bond with its lower interest rate suddenly looks, less attractive than the new ones being sold. So its price has to go down to compete. And of course, the opposite is true. That simple seesaw effect is exactly what caused that massive crash in 2022. But, and this is the big twist in the story, that exact same crisis, the thing that caused all that pain, has now created what a lot of people are calling a once-in-a-generation opportunity. I mean, just look at this. It's a night and day difference. Go back to the middle of 2020 and a 10-year government bond was paying you, a measly 0.5%? Practically nothing. Fast forward to today, and that same bond is yielding close to 5%. That's the huge yield reset we're talking about, and it has completely changed the game. So why do we care so much about that reset? Well, here's the key. If you look back at decades of data, it tells you one thing very clearly. The yield you get when you first buy a bond is the single best clue you have for what your returns are going to look like over the next 5 or 10 years. So let's put it all together. The very same interest rate hikes that absolutely crushed bond prices in 2022 are the reason we now have these much higher yields. And those high yields set the stage for much better returns moving forward. It's like the pain from back then created the opportunity we have today. But, and this is a big but, it's not a totally risk-free situation. Okay, so before you run off and put all your money into bonds, we need to pump the brakes a little. It's really important to look at the other side of the coin here. The path forward isn't a straight line, and there are some very real things to be cautious about. All right, so let's break down the dilemma. On the pro side, the argument is pretty strong. You've got these really attractive yields, the best we've seen in ages. Plus, if the economy slows down and the Fed starts cutting rates, remember our seesaw? Bond prices could really take off. But then there's the con side. What if inflation is stickier than we think? The Fed might have to keep rates high. And looming in the background is this huge amount of government debt, which could be a problem down the road. So yeah, it's a real tug of war for investors right now. So with all that in mind, what do you do? Well, there's no single right answer here. It's not one size fits all. It really depends on your own personal situation. Your age and where you are on your whole financial journey. Let's start with folks who are near or already in retirement. For you, these higher yields are, frankly, a total game changer. The whole point here is generating predictable income and making sure your money is safe. A really smart strategy is something called a bond ladder. Basically, you just buy a bunch of bonds that mature at different times. That way, you create this nice, steady stream of cash flow and stability. It's a great tool. Now, what if you're in the middle of your career, say in your 40s or 50s? Well, bonds play a totally different role for you. They're like the shock absorbers for your portfolio, smoothing out the bumps. But they also act as dry powder. That's your stable cash pile that you can use to swoop in and buy stocks when the market takes a dive and everything's on sale. And finally, if you're a young investor, in your 20s or 30s, the story is actually much simpler. You've got decades and decades before you need to touch this money. Your biggest asset is time. So your main focus should be on long-term growth. And that means you want to be heavily invested in stocks and keep your bond holdings pretty small. So when you step back and look at it, wow, what a turnaround. The bond market has literally gone from the worst crisis we've seen in our lifetimes to maybe the best opportunity in more than 15 years. It's a wild paradox, and it just goes to show you how fast things can change in finance. And that leaves us with one final, and I think really important question for you to think about. After everything we've seen, the massive crash, this incredible reset, have bonds gone from just being that boring, safe part of your portfolio to maybe, just maybe, the most important asset you need to be thinking about right now to hit your financial goals?